here's a question, Lisa. I want to get to some questions here. When do you recommend a more optimal time to list new property? May 15th, or wait until later? I mean, you're not going to have a days on market ticker. Okay, so in the sense that if you're worried about time, you're not going to have any penalty in terms of time. So I would list it. And the reason I would list it is because inventory is going down now. So that's something that as a seller, I mean, would you rather list as a seller in a time when there's a lot of inventory and there's 30 things that you're competing with, or would you rather list in a period of time when there's 8 things because there's no inventory? And I guess most sellers would say I'd rather compete in 8 things. You know, so in that sense, it makes a lot of sense to list now. I would just be very, very clear in managing your client's expectations that, all right, listen, I am in a no showings requirement here, okay? It's extended to May 15th. I don't know where it's going to end up. Maybe it's going to be June 1st. Who the hell knows? Clearly, that's possible. So that's number one. So number one, are you going to give me a potentially extended listing agreement? If I'm not allowed to show this until June physically, are you going to be able to give me an extra month or so? I'm just talking out here, just how to protect yourself, right? And number two, I'm trying to think. You got to let them know that the bids that they're going to receive is going to be probably 15 to 25% lower than where ultimately it would have been 2 months ago before this whole thing started. They have to know that. And I'd rather you manage their expectations heavily to the downside and prove incorrect and procure a bid down 10%. Because if you do that, then you exceeded their expectations, okay? So this dislocated market is a perfect narrative. We talked about that before. The dislocated, thinly traded market is a perfect narrative to sit down and explain to your sellers what you are selling into and knowing it, okay? However, with that said, I mean, you got to ask them if they have to sell or not. I mean, are you really looking to sell? Some sellers have to sell. And as Lisa said, the deals that you're seeing right now, the 124, whatever it was when we checked it, those are sellers that have to hit the bid. Most sellers do not like to hit the bid.
So Noah, somebody asked that they have a listing on the Upper East Side. They I guess put it on the market in February, and she had some visits but no offers, and she wants to recommend a price reduction, but she's saying, should I wait until after May 15th? What percentage of a reduction do you would think would work in this type of a market now? 5%, 35%, somewhere in between.
Yeah, I mean, if you're reducing 35%, then I mean, you don't want to do that. You don't want to reduce 35%. I mean, you were probably priced wrong in the beginning if you were reducing 35%. First off, you have to put the seller into a category of when they have to sell. I mean, do they just prefer? I would like to sell, but I don't have to. I mean, if you're telling me that this person has to sell, because these are situations that are realistic, right? We all know it's case by case. We all know that. So let's go to this case. All right, I have to sell in 30 days. Okay, 30 days I have to sell. You know what? I would do a damn good job of looking at 2 things. I would look at all of your active competition right now and really, really, really know where you stand in that active. If there's 10, 15 things you're competing against, are you the most expensive or are you the cheapest right now? That's number one. Number two, I would also look at any contract signed in the last week or two for any color on how much the broker, the seller had to go down to hit that bid. Because that's your best indication of where you might have to go. If they had to go down 10%, 15%, I would consider going down 10 or 15%. I mean, I really would not go down 35%. If you go from a million to 700,000, that's just, I mean, the market's going to look at that a little oddly, I think. But the pricing right now, if you don't have to sell, I got to be honest with you, I would hold off on the price reduction.
So Noah, the other thing that someone's asking, because you said, why not list now that's low inventory, blah, blah, blah. But if you can't show it, then what are we doing? Virtual showings? We're doing, you know.
That's exactly what you're doing. Yeah, no, that's exactly what you're doing. I mean, that's you're going into this knowing what your job is. That's the point of managing the expectations. That's why I said, how long is your listing agreement for? If it's 6 months, then I mean, you're only going to get really 4.5 months or 4 months, maybe 3 months. at the end of the day. And plus, how do you feel about where we're going to be when the restrictions are easing? I've mentioned before in the previous session, I don't think it's going to be flipping of the switch. I've been saying this forever. It's going to go in stages. And the ending stage of this whole thing is going to be sporting events. I've been talking about this for weeks now. Sporting events, concerts, mass gatherings. When that all starts happening again, we're officially back to normal. And we all know that's probably not going to happen until we get some type of mass vaccine next year. So we just got to fill in the gaps in our head. All right, it's possible we're in this dislocated market for a while, but you know what? In 5 months from now, we're probably not going to have anywhere near the restrictions the social restrictions that we're doing today. You know, so you got to think about these things. You just strategize in your head when it comes to your listing agreement. I mean, if you think May 15th is going to stick, okay, just think about this. That's another month. And if you also think that it's going to take a month or two to get back to normal, well, then you really only have half a listing agreement. I'm just saying. So, like, if you do list now and the seller, so you both decide to do it, okay? And the reason I'm saying do it is because you got a lot of buyers out there looking. You can't show it. They all know what's going on. You're probably not going to get a great offer in the next 4 to 6 weeks. Let's just be real. Probably not. Unless...
If you're going to do a virtual, because I'm getting all these things, I mean, a seller could take a virtual of his own apartment if no one can get in because the buildings aren't letting people in, right?
Well, that's another issue. If they may ease restrictions, and then certain buildings will have their own policies about showing. Like that's what I'm talking about. Like I don't think it's going to be like a flip of a switch. So if you think it's going to be 3 months, you have to talk about extending your listing agreement or talking about the potential of extending the listing agreement. You're probably not going to get a bid like within 3% of your offer. You know what I'm saying? Like buyers just by naturally are going to be putting in lowball offers. Okay, this naturally. But they're all watching. They're all looking. Inventory is declining. And buyers are like, all right, my options are going away from me. So if if inventory is 20% lower in 3-4 weeks, and you're one of the ones that are out there, maybe you get looked upon. Maybe the restrictions, I mean, you just don't know. You know, I'm just saying that inventory is going down as long as you have a timeline for this thing. You know, I almost feel like listing agreement should be 8 months. I know it sounds crazy, but it's only because of this weird, unprecedented near-time uncertainty that's going on because the next 2 or 3 months, you don't know what's going to happen. You don't want to be in a situation where you advise a seller to wait for whatever reason, and then, God forbid, your loyalty wasn't as strong as you thought, and you see that listing somewhere else with another broker. I'm just saying. If you know for a fact this is a loyal client and they're going to trust everything you're going to say, you got to look at what their needs are. If they have to sell right now, I mean, you got a little choice. You know, if most sellers don't have to sell, that's the thing. Most sellers don't have to sell. The ones that do are hitting the bids right now, and we're seeing it in terms of volume. If everyone had to sell, you would see contract activity just as high as it was last year in the thousands. If everyone had to sell, they would hit the bids down 20, 30%. But think about it, how many bids did buyers put in over the last 4 weeks that were not entertained by sellers? You guys probably know this. You guys are brokers. You're out there. Have you guys gotten lowball bids? Lisa?
Well, the only activity personally that I've been having, and thank God I've had some great buyers that did not renegotiate. In fact, we've had a couple closings just in the last few weeks, and they were done virtually. The walkthrough was done virtually, and thank God they closed. But I do have a question for you because, Noah, you've been talking about this normal. So somebody's asking, how are you defining normal? Like, you know, when we go back to normal, what does that mean?
Well, in the sense that I just said it, I mean mass gatherings are now allowed. When you can go to a Major League Baseball game, and you can go to a concert, and you can go to a Broadway show, when that starts happening is kind of like when it's normal back to before it was, before this all happened, like in December. You know, I mean, no one really thought this was going to evolve the way it did. I don't even into earlier this year. You know, no one really thought. And I think it's going to take a while.
different, very different than all the other ones because we were able to do business. And
Yeah.
even when this comes off, like someone mentioned, the buildings have their own, you know,
It might take a year. It might take a year. All right. And if I think, let's just be real here. So 9/11 took a year. I signed the contract in October 2000. I signed the contract after 9/11, not because I was so prescient that I thought something was a great time. Not because of that. I was following the market a long time, and I knew it was a good time to buy. I knew that, but I didn't know it was like going to reflate as much as it did. I just bought because I found a great place that I love. And if you think about this crisis, it really, I've said this on a couple interviews. It's like a sick mad child. It's a great term. Sick mad child of 9/11 and the credit crisis. And in the sense of 9/11, we had a shutdown and there was fear. For a couple of weeks. It was severe for a couple of weeks, and then it started easing, and then a few months later it eased some more. But I remember when I signed the contract, and it was very fearful. All right, very fearful. This is what buyers need to understand. You got to have thick skin, right, and to be able to handle the volatility over the next couple of months. But it was very fearful, and I signed the contract, and everyone was telling me I was crazy. And every few months, buildings were getting evacuated. Every few months, and I was like, "What the hell did I do?" And at the end of the day, it was the best move I made. But in the sense of 9/11 was a shutdown with high levels of fear for a period of time. It's in no way respect similar in terms of the depth of this is the everything thing, right? This is the whole world. The credit crisis, like people, all right, first off, I'm a trader, right? So I'm a trader first, real estate second. I was trading from 1993 on, 98 professionally, 98 to 2002, I traded and I got out of it. Once decimalization came on and it went from from fractions to decimals. The stock market used to be fractions. Once it went to fractions to decimals, I couldn't do what I was doing anymore. That game was over. But I was a trader first. And one thing I know, and if I could just summarize, like one thing I've learned over 20 years is the credit markets, the short-term credit markets. I don't want to get too high level here, but if you just want to understand what's going on here and why the credit crisis happened because the credit markets, in specific relation to mortgage-backed securities, all the banks, which was a big sector, $1 trillion, whatever, that all got crazy, and that led to the great financial crisis. And the Fed came in and did a whole bunch of stuff, and it took them a while. It took them months. Lehman Brothers happened. We had a credit event. We had Bear Stearns. We had Lehman Brothers, right? And then we had that was 2008, and then we had the bottom in early 2009. 6 months later was the bottom of everything. So if you think about what's going on now, the world, the global chain, everything functions like a big bicycle. And imagine a big 10-speed bicycle where both of the wheels are the economy and the banks. And if you think about the gears, the 10-speed gears, right? Those gears, you can go from one gear to two gear. One of those gears is the commercial paper market. One of those gears is the short-term treasury market. One of those gears is the euro dollar market. One of those gears is the overnight repo market. So there's all these little markets that are trillions and trillions and trillions of dollars each. These are trillions, okay? When stress hits those gears, the whole bike, the whole machine cranks down and doesn't move. And so if you think about what happened here, we had a global virus, an unexpected global virus. In addition, this is what no one talks about, in addition to a price war, an oil price war between the Saudis and Russia. Again, high level, but let's just understand what's going on. So you had an oil price war, you had this global viral pandemic. Both of in of itself would have been crazy enough to cause a downturn, right? It happened at the same time. And in response, the Fed and the government has done insane levels of massive fiscal and monetary stimulus. And the Fed specifically has done 4 to 6 trillion to keep those short-term markets so that we don't have a Lehman Brothers. That's what you guys got to understand. Like everyone that's wondering about, like, oh, the Fed, there's a reason. I'm not saying whether or not it's right or wrong. Like, you got to put that aside. They're trapped, and we're in a credit bubble of everything credit bubble, and there's nothing. The only other alternative is to let it fall apart. And if we let it fall apart, the stock market will be 70% lower, and unemployment's going to be crazy. So you have to understand that we're in this crazy environment, but we have massive stimulus behind it. So now I look at what's going on right now, and I look at the differences. They put all this stimulus in place very, very, very fast. amazingly fast. And almost like it's 6 trillion now. It may go to 10 trillion, 15 trillion by the time it's done. So at the end of the day, we might have a lot of buyers. There might be like we call this a put, a Fed put, which is like a floor in the market. They may be a floor on the Manhattan real estate market. And the deals that are going to define the Corona market period are going to be few and far between. It's only going to be like hundreds, maybe 1,000 or less. Like if you look at how many deals were signed mid-March, April, and May, it's probably going to be maybe less than 1,000 that are going to define that Lehman moment kind of thing. So like I look at this and I'm like, all right, Manhattan has experienced a dislocation like Lehman moment, right? But we really haven't had that Lehman. We haven't woke up and have Boeing nationalized. That's like a Lehman. So the Fed is doing everything to prevent a credit event so that this whole thing that we're facing doesn't cycle into a greater financial crisis that is in magnitudes of what we saw in 2008 and 2009. It's still possible, but that is why the Fed's doing everything they're doing to keep us out of this. And I think at the end of the day, that's going to cause a reflationary wave. And I think there's a lot of money out there that's going to be looking to be put into distressed assets, including Manhattan real estate. We're just going to be in this period for a long time. I think it's going to be one of those periods that's looked upon like, oh, did you buy after 9/11? Did you buy after the Lehman Brothers? Did you buy after the 2020 coronavirus? Ultimately, I think that's what it's going to look like.
So here's a question.
I would buy right now. Margo, right? I'm not. Okay, look. My liquidity is in Urban Digs. Unfortunately, I don't have liquidity. Someone asked me this. I wish I would have bought 3 weeks ago. If you bought 3 weeks ago, I'm hearing some deals. Now, I don't know how many co-ops are going to allow. There might be co-ops that cancel these deals. That may happen. But I'm hearing some deals. I have brokers calling me saying, Noah, I have board people showing me deals that are 35% lower that were signed in March 15th. Like there are some outlier, dislocated, extreme deals that were done in March that are yet to be funneled through the system. I wish I was one of those buyers. Because your pricing, it's not going to last that long. That discount window is not going to be open too long, and it's not going to be as wide as fearful as it was. Like today isn't as bad as what 3 weeks ago. Sorry.
So someone said 9/11 was not a financial crisis, and while it was a shock, it didn't have a lasting effect. But 2008 is more comparable with the metrics because. That's more similar, but they're saying it took 3 years to even start to recover.
All right, so I'm going to share my screen and let's look at some data. Okay, so you guys can see my screen, right?
Yeah.
Okay, so let's go to the charts and let's talk about it. First off, we all know that sales data is lagging, right? So this sales data right here is a few months, lagging. So let's just go to this and take a look. This is price per square foot. All the way back to January of 2008. That's how far back I go. So technically, if you think about the fact that the lows was in probably early 2009, those deals probably sold 4 to 6 months later. So February, March was the lows. So the deals are going to probably show around May, June, July. Okay, and here it is. These are the lows. These are the lows from deals done early. It takes 4 or 5 months to filter through. So now if you look at what we've done since then, take a look at since the lows, it took like a couple of years to even get back to where you were beforehand, that peak. So it took a while. Like we went down, we were down, like it took a year from 2008 to 2009 was bad, and we stayed down for a while. And it took, according to the stats, it took until 2013 to recoup, whether it was a 20% move down or a 15% move down or a 30%, who knows what the median was, but it took 4 years. 4 years to get back to where it was before, and then we kind of had the golden years of Manhattan real estate, which was 2013, 14, 15. Okay? This downturn that we had recently, I've been talking about often, this has been a progressive, policy-driven reset. where we just kind of went lower, 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 lower over time. All right. Don't look at this little bump right here. That's the stupid mansion tax last year, where we had a pull of deals before the mansion tax that screwed up the stats. That's kind of what happens. All right. But we had a progressive deflationary decline for 5 years since the 2015 peak that hit the high end in the luxury sector and the multifamily market, townhouse market, much harder than the lower end. But it took 5 years. It was like a death by 1,000 cuts type of thing. And we were just coming out of it. And then this hit. So now you're asking me where we're at? I mean, now you're at where you were in 2009. So now we have a dislocation. And let's be clear, guys. Let's be very clear. All these deals that are being signed right now, think about it. When do these physically close? June, July, physically. August. And then when they close, how long does ACRIS take to file? We all know 3 weeks, 3 months. Okay. So all of these deals are not going to impact our numbers until Q3. You could look ahead. You could accurately predict the future. You could tell all your clients, you know, exactly where the numbers are going to go and when it's going to come. It's going to be around Q3. You know, I don't know exactly. July, August, September, October, that time frame.
So what price are you going to put on the listings? 2009 or
No. You gotta look at your active inventory. You got to look at your active inventory. You got to see what your competition, your active inventory, especially those that have to sell, should have lowered their prices to reflect the fact that they need to sell in an illiquid market.
Noah, do you have an
That's a good question.
Of which parts of the city are faring better than others?
So, and I want to get to the banks question afterwards that was asked. Let me just go back to Urban Digs here. Okay, let me share my screen and show you what I can do. So what I can do, if I go to my chart room, and it'll take a second to load here, I have what's called the market pulse. Okay. And that's what I use to kind of figure out which markets are doing better than others. And it's basically a barometer. It's a barometer of supply and demand. And right now, 48, that represents 48%. 48% of what? Well, it's a pending sales, meaning demand, all the demand. It's a pending sales ratio to inventory, supply. So 2486 is about 48% of 5162. So now if I go to financial district, okay, and type in financial district, the market pulse of the financial district right now is 0.15. So I know that as the market pulse goes lower, that's a much weaker market, that the supply-demand imbalance is much more in favor for buyers. The lower the market pulse goes, the lower, the better the market is for buyers, and leverage is on the buy side. The higher it goes, the better it is for sellers. Now, if I go to Upper West Side, okay, whoops.
Well, that's
0.67.
all Upper West Side.
Yeah. Okay. Or you could just do regular Upper West Side. 0.67. Look, 0.76. See, the Upper West Side is outperforming. I mean, you know, relative, it's got a lot of deals. Sorry. It's got a lot of deals relative to inventory. There's no inventory. You know, what's the Upper East Side compared to, let me go check it out. It's going to be much different. That's much more in line with the market, 0.49, you know. So every market's local. And, you know, I can go to this market and take a look at what's going on over time, and I can see that if you go to the chart, it will show you buyer, seller's market. What it does is it basically defines a threshold of all these data points going way back to 2011. And then it puts those onto a count, and then it finds the median, and it defines a threshold. So you could see when the seller's market was and when the buyer's market was and where you were. And you could see we were coming back. Now, here's something very interesting. This market pulse is rising. Let me just go back to the chart room really quick. Okay. The market pulse rises when the pending sales, the demand to supply balance starts to get more in favor of sellers. Okay, so it's rising now, and you may ask, well, why? Pending sales is going down, demand's going down. And the answer is true. Yes, it is. But the reason is because inventory is so much lower. That's why it's going up. So that's why buyers need to understand that narrative that they're buying into an illiquid, thinly traded market. And the reason it is because A, there's not a lot of inventory, number one. And number two is, even if you find 2 or 3 places, if you're going to bid down 20% or 15%, that seller may not be willing to do that right now. And that's why everything is so thinly traded. And that's why there's so little volume. And that's just going to continue. So one thing I got to look at is whether or not to look at this market pulse and incorporate my off market, because that's what's going on right now. Supply is falling because it's going off market. If I go to a 3-year chart, you can see right here, there's the off market. That's supposed to fall right now. That's supposed to fall right now. This is usually when this number falls and we fall way down, okay? And now it's rising. It's rising because all that inventory is that usually, if you think about it this way, why would someone take their listing off the market? Well, if I'm not getting the bid I want. Oh, okay. Well, why wouldn't they take it off the market? Well, because I'm getting the bid I want. So like off market, it goes down in good times when sellers don't need to take off market, and it goes up in bad times. It's one of those indicators. A lot of people don't look at this, but this is that missing element. There's a good question about the banks here I wanted to talk about. Can I mention that a second? The banks here? That's a great question. And I'm going to start doing some podcasts with attorneys and lenders. And I got Adam Turkowitz I'm going to do a podcast with. He's at Wells. And he is awesome. And he's going to be doing a podcast with us next week. And I already listened to some of his stuff. And I'll try to translate what I learned from that meeting that he had. Basically, right now, the banks, it's not a declining market yet. I'm like, is it a declining market? Yes, it is, but it's not dictated from an appraisal standpoint as a declining market. Why? Because the sales are lagging. It's like, I totally get it, right? So yeah, it's going to take a couple of months for those sales to come in that show down. And then when those sales come in and it comes down, we're going to probably dictate it's a declining market. So from a bank perspective, you're going to go into a kind of a darker period of the lending industry. Okay. Number two, credit is being constrained. That's what happens in deflationary times. We're in massive deflationary times. Deflation. That's why all this stimulus is being put into place. Forget about hyperinflation and all that stuff. That's just not going to happen, right? We're in deflation. Everything's going down. Everything's getting destroyed. Credit's getting destroyed. Debt's being destroyed. And the Fed's trying to reflate us to get back. That's kind of what's going on. So number three, all right, so that's credit constraints. Higher credit scores. JP Morgan now is 700 credit score or higher. More down payment, okay? LTVs, that's going to change, okay? And think about this. They're already having an issue, and this is something you don't think about. They're already having an issue with pipeline existing deals, okay, contracts signed, where they physically can't close. And now the loan commitment is expired. This is like our worst night. This is what killed me as a broker when the loan commitment expired at the last freaking minute, and you're just about to get the deal done and everything, and the loan commitment expires. So like the loan commitments are expiring. So the buyer has to come in and submit new paperwork. You could follow the daisy chain here, and their job or job right now, as it pertains to where it was 4 months ago, or the numbers are totally different than where it was before when they applied. And they might have to now go through a reapplication process, and things might change, and there might be a financing problem. At the end of the day, the banks are hesitant to loan, and they're constrained in lending capacity in times of deflation where credit is being destroyed. And that's what's going on right now in the banking sector. And that's why the Fed's doing what they're doing. That's why I wanted to talk about the credit markets and how important it is. Like it or not, if they don't liquefy and keep that sector going, everything kind of collapses on itself. It's just we're in a boom and bust society, and there's nothing we can do about it. Banks are going to be tough.
What's the absorption rate like now? And do we do it in different neighborhoods? Do we break it down? Because we didn't do the downtown market. I was curious to see how that was doing. But
Yeah. Let's
when
check.
you do absorption rate, do you do the whole city? Do you break it down by neighborhoods? Or give me your thoughts on that, Noah.
We do everything. So I'm on the Urban Digs chart room right here. I have market wide. I got resale. I got new development. I could use my overview section to go pick a neighborhood. So I could hyper localize this. I could do property types. I could do beds. I could do Brooklyn. So let me just scroll down here. The absorption rate you're talking about is right down here. Okay, and let's just define what absorption rate is so people understand. What's confusing about absorption rate is that it utilizes a different period in time. What absorption rate is trying to do is it's taking a look at your monthly pace of sales, okay? 896, that's your monthly close sales, okay? And based upon that, how long is it gonna take to absorb inventory? But the inventory is real time. The inventory is updated every single day. The monthly close sales, because of the ACRIS lag, we have an ACRIS lag, you guys all know about it, is delayed. So I can't show you March sales because March sales are like 40% complete. I can't show you February sales because right now it's probably 60% complete. So if I throw a number out there, it'll be wrong, right? So I wait on it. So this is really looking back 2 months. It's going back to January. That's what the absorption rate's looking at. So based on 896 and based on where inventory was, it's taking 6.4 months to close out and absorb all that inventory based on that closed sales volume. So in essence, the higher it goes, the weaker the market, and the lower it goes, the stronger the market. So it's at 6.4 months. I mean, it's a good indicator. It's not my go-to because it's lagging. And right now, see, like, look, it's been declining. It's been declining because it's starting to reflect the fact that we were actually coming out of it. This is what kills me. We were coming out of it. We were coming out of it. And these numbers, these sales numbers are going to be positive for the next 3 months or so. Like, we still have to filter through Q2. When Q2 reports come out, it's going to be representative of closings in January, February, and March. The Corona thing really started to hit us in the second week of March. So it's really a Q2 phenomenon that's going to be reflected in Q3. So we still have one more quarter or a couple more months of positive data from the fact that we were turning around.
So when you quoted those April numbers, the 408 off the market,
yes,
40 active new listings, and the 124 in contract. I'm repeating it because someone asked me to.
yes.
And that's just for 15 days. That's the entire city, or did you pick a?
That's Manhattan. I'm doing it again right now. I'm just going to my Urban Dig search tool. I use my custom. These are my two best buttons. I have my custom date button and I have my status button. So if I do active and I do these time periods, it's going to say, all right, well, what was newly active on those time periods? That's how agents wanted to use Urban Digs. So the answer is 140. All right, I could just toggle this now. Well, how many contracts were signed? 124. How many came off market? Okay, and I could do this this is what I do. This is what you guys, this is a great opportunity for you guys to get good with Zoom. Clearly, we're still learning our Zoom over here, and I apologize for that whole thing this morning, like craziness that we just experienced. But get onto Zoom and do these one-on-one engaging videos. Like if you have buyers and sellers, I would separate your contacts between here's my buyers, here's my sellers, and here's my everyone, right? And for your buyers, I would just do a special piece for them and say, here's what I'm looking for. I'm looking for off market to go down. So you do a 1 week look. This is how you do this, okay? You do a 1 week look so you have a sense of consistency. Maybe you do it every Friday. Maybe you do it every Sunday, all right, whatever it is. And you can say 1 week off market, 130 came off last week, okay? 1 week active, let's see, 60. Only 60 came on the market. Contract signed in the last week, 45, okay? And so now you do this, right? So you're getting an understanding of what the weekly pace is. And this is going lower and lower and lower and lower and lower. It's been going lower, right? And now at some point, you're going to get to a point where it's like, all right, contract signs now 60. It's not 45, it's 60. And then it's 72. And then it's 85. And it's 102. And it's going to start coming back. And the same thing with active inventory. What you're looking for is you're looking for contract signs to rise. You're looking for active inventory to rise, okay? And you're looking for off market to fall. You want off market to go. You don't want people taking listings off market. You want them putting them on market. So you're looking for, that's what you're looking for. And if you keep track of this, you could identify when the trend is starting to change on a weekly basis, and keep your buyers in the loop. So those buyers that all of a sudden were scared or weren't sure on their fence, they now have pure data, pure trends, and you're interpreting it. So you're advising them and consulting them while you're doing this. In the meantime, you're getting very knowledgeable about the markets. You'll be able to talk about it to anyone and everything. And again, I think we're going to have a wave after this where you're going to have buyers that want to do deals. You know, if anyone thinks there's going to be an inflationary wave later on, and I'm part of that, there will be an inflationary wave later on, just not now. You're going to want hard assets, and you're going to want real estate's one of those assets. So, like, get the deal while you can. I don't think today you can get the deal that you got 3 weeks ago. I'll say that already. Try to look at this as a discounted period, and in this discounted period, you're going to have different phases and windows of acute severity and fear versus not. We're still dislocated, but we're not nearly as acute and fearful as it was 3 weeks ago. So that's something we're going to have to go through.
So Noah, in light of these numbers that you've provided us today, you know, painting a pretty, very true picture of the housing market real time, and the knowledge you have over the last few weeks, 5 weeks, whatever. And I'm not asking you to do a prediction, but do you have an opinion perhaps on what the market will look like post COVID-19?
I have opinions on it. Just like everybody else, I'm not an expert on any of these things. I'm hopeful that in the next couple of months, there's a treatment. That's what I am really hoping for, that the scientific minds across the world, and there's some amazingly brilliant people, the companies in this country, amazingly brilliant people, are working. Everyone's working on this. And if there's a treatment so that people stop dying, if people stop dying, you might have a change in how the recovery works. If we don't have a treatment and we just kind of continue like this, but the cases fall, maybe there's a second wave, I think people are going to be cautious. And how cautious depends on everyone. Everyone's unique. Everyone's level of caution is unique to their own, how they view the world. Some people are much more cautious than others. So you're not going to have that mass come back. And again, I think it's going to be a year. I think in a year, by this time next year, I think the sporting events are going to be back on. We'll have a vaccine. Sporting events will be back on. I'm hopeful. I think they're going to expedite everything. This talk won't be till fall of next year. But I think a lot of the governments and a lot of these mass public events, there's too much pressure. And again, if people stop dying, if we have a treatment so that people stop dying from this, and everyone gets back to normal a little quicker because now we have a treatment. So yeah, you're going to get sick, but you're not going to, you're not going to die like we're seeing now. That's huge. So that's like the X factor here. So I think that's the variable here. I'm hopeful that's going to happen. I still think it's going to take people at least months. Even I am not a germaphobe. My wife is not a germaphobe. Okay, our house is clean, but it is not super clean. You know what I'm saying? Like we leave our boots on when we come out. We don't take them off. We still walk around the house. We're wiping mail down. You know what I'm saying? We're wiping the cereal boxes down, and we're wiping the car handles. I'm opening up to you guys. Like I don't know what you guys are doing, but like these are the things we're doing when we actually have to go out. My wife made masks for us. So like, all right, so they're going to ease restrictions in 3 weeks. Am I going to just stop doing that? Like, you know what I'm saying? Like I think it's going to take months for us to recover because we've never experienced anything like this before. It's completely new. There's no playbook for it. So I think it's going to take a good year, to get back to kind of normal, unfortunately.
Kind of offbeat, but it just popped into my head. So do you think that that will have a positive or a negative effect on the rental market?
It's a great question. I originally thought that a lot of people that would have been buying are going to be on hold, and now they're going to be renting again. So the rental inventory is going to get impacted, and rental prices might rise. But, I believe in inflation and deflation, and in deflationary times, generally speaking, rental rates will fall. So I'm kind of leaning to like my school of thought of how I think from a trader perspective. I think rental rates will fall. I think in a deflationary times, I think you have a lot of people that unfortunately are going to be hit hard from this. We don't know how jobs are going to look. We don't know if there's any social or demographic changes in the city in terms of populations and who wants to leave and who wants to stay. There's all this talk about people that want to.
Stock market.
Yeah, there's so many different things going on right now. So I would guess that deflation rules out the fact that there's maybe some momentum because buyers are renting. I think deflation rules out on the rental side, and I think rental rates get pressured to the downside.
Thank you. So Noah, in conclusion, I'd like you to take the opportunity to show us your new launched tool and how to manipulate it for various strategic analysis.
Oh, okay. Well, I mean, yeah, I think I showed you some stuff, but I could show you a couple.
Some really cool stuff yesterday that I'd like to share with the group because it's brand new and it's really cool.
Yeah, I mean, so basically what we have is we have a CMA pricing tool, right? So you can let me just do my report here. And I don't know what firm I'm set here for, but you can go and do your subset. And imagine you're doing a conversation for a seller, right? So for a seller, the conversation is going to be, hey, listen, I need to know everything that's active in contract, off market, and closed that we're similar to and comparable to, and all the high-level stats. So we have this CMA report tool that lets you do all that, and it lets you select all the listings that you want to select to the report, and you can toggle through everything, active in contract, closed, et cetera, and get all the high-level stats that you need for a conversation. All right, I'm just showing you really quick how this works, okay? And you can go ahead and you can export this, and you can export this with a full layout. You can export this with an inline layout. You can add client name over here, identify the property, et cetera, et cetera. It's just a really good system to have a high-level conversation about what's going on. This obviously is not, this is just active one-week inventory, so it's not going to show you specific zones, but you could also save and add more, and you can compare different searches. So like, for example, if you have a 2-bedroom 1-bath, you can go and do a 2-bedroom 1-bath search, and then you could save all those, and you can compare it to a 2-bedroom 2-bath search, and you can identify it, and you can say, hey, listen, you're a 2-bedroom, but listen, you're not priced the same. So it allows you to do all this different functionality, and at the same time, we have our charts room, which I was showing you before. And one thing I didn't show you on the charts room is the ability to create multiple charts. So you can go in here and you can just click on one of these charts over here. All right, and you can scroll down, and it'll just be really quick. I know you guys got to go on with your day. And I can click Add Chart to Share. Okay, and it's just going to load up. And I can go back to the chart room, and I can go and put together a whole report now. So I can go do a market pulse. I could go do a supply. I can do a days on market. And I can continuously add this. I can do new development. I can do resale. And the point of all this is really just to be able to give your clients the level of transparency. If your clients have transparency, they should be able to make smarter decisions and be a little more confident in their decisions, a little more comfortable in their positions. In the decisions. And this is the time to give data because everyone is confused. And look, there's ways to track this. There's ways to track the market. You could use the dashboard and track what's going on so you can see it in a real-time basis. That should give some clarity to buyers and sellers and let them know what's going on. You just have to explain to buyers right now. I think the key is buyers need to know that not every seller is going to go down 25%. That's what I think is the big difference here. And you're not going to see it in the data. Like buyers may say, show me the data. You're not going to see it in the data until August, September, October, and by then it's over. You don't know where we're going to be at that point. Okay, so if you want to capture it, you got to be willing. The buyers need to be willing to actually be a little more negotiable. We did a great podcast with Stephen Matz of Katz and Matz. It's coming out on Monday. Amazing nuggets of information there. What he's seeing on the legal side, but he's saying the biggest challenge right now is like the one thing agents can do to get deals done in the future over the next 4 weeks during this crisis is talk to both their sellers and their buyers that you have to both be just a willing to negotiate because the seller's not going down 25. And the buyer's not going, the buyer's not going to accept 25. It's going to be somewhere in the middle, somewhere between 10 and 20 is probably where it's going to happen. So manage those expectations.
I agree. I think that we will definitely need to get a little stronger in managing the buyer's expectations, because I mean, the seller knows what's out there. He knows what's going on, and he will be a little pliable. But the buyer needs to know that we were already down in prices, So
Yeah.
again, you go, what are you try to quantify the deal, not just based on numbers, but, other things. And you try to make a deal that way. But I really think we're going to have to educate our buyers and not let them think that they're going to dictate this market and take us by the noose and, get me this deal for 35%. It's not going to happen.
Show them the contract activity charts. Show them the 1 week contract totals relative to what's usual. And you could say, hey, look right here. It's the sellers are not hitting all the bids that are coming in. Okay. That's very important. Abe Rosenberg had a really good question here. I wanted to get to it. I just lost it really quick. Where are you, Abe? Sorry, hold on a second. Abe, you had a question here. I know it. I saw it. Give me a second. I can't find it. But it was a good question. It's here somewhere. If someone sees Abe's question, if you can copy it in the chat room. Oh, here it is. So are there pockets of buyers like people getting married and growing families? Look, we don't know demographics of the buyers, right? I mean, it's just not something we have a trackable thing for. And I imagine you're asking this question about contracts signed, like who are the buyers today doing contracts? So we definitely don't have that information. But I will tell you that the buyers, this much I pretty much know, for the most part, not all, but for the most part, your buyers are going to be your opportunistic, they can handle risk, they can handle uncertainty, they love times of distress. And then you got your FOMO, those fear of missing out types of buyers who's been waiting for this type of moment. That's the money that's being put to work right now. People that know how to take advantage of the situation. It's not great to talk about. You don't want to hear anyone in a bad position. But look, in times of distress, when there's no other bid to hit, I mean, if you're a seller and you have to hit a bid, like it's not like the stock market and you got bids all there. This is illiquid. You need money. You have to liquidate. You've got a margin call. All we could ask for is that we actually have a functioning marketplace. So if that bid's down 20% or 25%, if the seller chooses to hit that bid, then we just got to hope that the market could produce a bid like that. So, and I think that's what's going on right now. The downside is that it's just very low volume. Very, very, very low volume.
You know what? No, I just thought of something. Co-op are not going to, I mean, it's not like, okay, just bring any bid and, the seller is so desperate, he'll take any price. And then the co-op board's going to say, okay, no problem.
That's going to be a problem.
At $1,
Yeah. The co-op board's going to be a problem. We're in the same situation as 2009. The banks are starting to constrain. Same thing, guys. There's similarities along all these levels here. What's different is the depth of this crisis. Where we were from a credit perspective before this crisis, everything was just priced for perfection in the credit world. There was a big bubble, and I talked about it in January 30th. My biggest fear was a stock market correction. I did not expect this. This is just crazy. The whole world shut down, and we don't know how long it's going to last and all that kind of stuff. What's interesting about this situation is the central bank response and the monetary and fiscal response. That could be, I mean, again, think about what happened in 2008, 2009 and where we went. That response was like $1 trillion. And that was for the mortgage-backed securities sector, so the banks wouldn't fail. This is like $5-6 trillion, and it's going to probably be 10 to 15 trillion by the time it's done. Like, I mean, can we fathom those numbers? Like that's not going to kick in until like a year or two from now. Like that takes time. There's going to be infrastructure plans. I guarantee you, there's going to be all these crazy new deals. The New Deal type plans. To combat this massive deflationary force. So, do we have an inflationary wave behind us? That's a very, very different scenario. I think there's a lot of buyers out there that do think that way. I'm hearing a lot of income. Okay, here's something that's interesting. And listen to my podcast on Monday, by the way, with Steve Matz, because he talks about this. Not a lot of buyers are breaking contracts. Not a lot. He's like, I only had one in my whole firm. Okay, I did a check. It's a little bit, but it's not a lot. It's like in the last month or so, it's like 60. Last year it was 50. So like relative speaking, it's up, but it's not up that much, kind of thing. So a lot of buyers I'm hearing, like I'm talking to colleagues. I'm like, all right, so you got any deals signed? Like, yeah, I got deals signed, but not really in the last week or two. Who could do deals? And I agree with that, right? But I'm like, when your deal signed? Kind of like right before, And I'm like, well, are they going to back out? And I'm like, no, they're for the most part, they're happy. They want to close. Their biggest concern is, when can I close? So there is renegotiation. No one's denying that, but it's not like this mass thing where everyone's trying to get out. You know what I'm saying? So like you're going to have this dislocation, but it's going to be an outlier in the sense that we're here, and then boop, we just drop straight down, like out of nowhere. It's like the biggest cliff dive you can possibly imagine. It was just, all right, shut down. Even 2009, I mean, like you had Lehman in 2008, you know what I'm saying? And then in 2009 was 6 months later, like it was a process. This is just like, boop, straight down, reset, new market, where we're at. I don't know. Let's try here. Let's try here. Let's try here. A few bids get hit. And that was where we were 4 weeks ago. And now it's like, all right, now we're a little better. Now we're a little better. And that's where we are today. We're not great, but we're a little better. So it's just it's unprecedented. I can't fathom $6 trillion plus in stimulus and what that's going to potentially do. It makes me think two ways. Like one, I'm like, oh my God. Like I think I have an understanding of the credit markets, because I was a trader. A lot of people don't understand when I talk about that kind of stuff. But it's like, was it really that bad that they had to do this? That's scary. Like, and that's the case, like how much more do they got to do? Right? That's a little scary, right? Like it must be hundreds of trillions or something crazy like that. And the second part of me is like, all right, look back to 2008, 2009. They put $1 trillion into that whole thing with TARP and TALF and all that kind of stuff, QE. This is 5 to 6 times that and make it 10 times that by the time it's done. And what happens if in 3 months we have a treatment? What happens? What happens if, let's just be optimistic for a minute. What happens if we have a treatment and people stop dying? Right, and now you got $6 to $10 trillion worth of stimulus that's going to be funneled through the system to put us back to where we were. Right, you're going to have problems. There's a whole bunch of different 2008, 2009 level problems that are yet to funnel through the system. How many commercial real estate is not paying? People are not paying. How many banks are seeing defaults right now? Right, you got a lot of that stuff that has not happened yet, and it's just so early in the game. But the Fed, man, did they come in? They came in fast to kind of stop this so that we don't wake up one day and see a Lehman, see JP Morgan or Morgan Stanley's now nationalized, because that would have just destroyed everything. That's why they're doing what they're doing. Yeah.
All right, Mr. Noah, I appreciate all your wisdom.
Hey, thank you. Thanks for having me.
We will definitely do this again.
Next time it'll be like on the right account. Sorry about that.
I'm thinking we should try to do this at least once a month so we can see, we can hear what's going on. And one thing is, yes, we can interpret, numbers on our own and, and on the neighborhoods that we do, but your kind of big picture, and you can read the chart and give us some intel that we might not have.
Thank you so much.
Right? So again, I appreciate you. Thank you for all your new, every time I ask you to do something, you do it right away, and I appreciate that. And you rock, and Urban Dig rocks, and thank you for keeping us informed, and we will do it again.
Great. Thank you guys so much. And again, apologies for the hiccup today, but we'll make sure it doesn't happen again. And everybody, please stay safe, and we'll get through this.
All right. Bye,
Bye,
everybody.
guys.
Bye-bye.
Bye.